Hello friends, welcome back to Book Demystified once again, and today we are going to discuss about the book A Beginner's Guide to the Stock Market by Matthew R. Kratter. You know what, I was just talking to my neighbor Sarah last week, and she mentioned something that honestly broke my heart a little bit. She said, I've been working at the same company for 15 years, putting money in my savings account every month, thinking I'm being responsible. But when I looked at my account balance and compared it to what I could have earned if I'd invested that money, I realized I've essentially been losing money to inflation all these years. And that conversation got me thinking about how many of us are in the exact same boat. Picture this for a moment. You're 25 years old, fresh out of college, maybe still paying off those student loans that seem to follow you everywhere like a shadow. You land your first decent job, and after covering rent, groceries, car payments, and all those subscription services that somehow multiplied when you weren't looking, you managed to save maybe $200 or $300 a month. You feel pretty good about yourself, right? You're being responsible, you're saving money. But here's the thing that nobody really talks about in those high school economics classes, or even in most college finance courses. That money sitting in your savings account, earning maybe 1% interest, it's actually losing value every single year because of inflation. Let me paint a picture that might make this hit home. Remember when your parents used to tell you about buying a candy bar for 50 cents back in their day? Well, that same candy bar probably cost you $1.50 at the gas station now. That's inflation in action, and it's not just affecting candy bars, it's affecting everything from your rent to your groceries to your gas tank. The Federal Reserve targets about 2% inflation per year, which means your dollar today will only have the purchasing power of about 98 cents next year. Now multiply that over 10, 20, or 30 years, and you start to see the problem. But here's where things get really interesting, and this is exactly what Matthew Kratter dives into in his book. While your money in the bank is slowly losing its purchasing power, there's this whole other world where money can actually grow and work for you while you sleep. I'm talking about the stock market. And I know, some of you just had that immediate reaction of, oh no, that's gambling, that's risky, that's for Wall Street guys in fancy suits. But what if I told you that some of the most successful investors in history started exactly where you are right now? What if I told you that the stock market, when approached with the right knowledge and patience, has historically been one of the most reliable ways to build wealth over time? Think about this for a second. If you had invested just $1,000 in the S&P 500 back in 1980, do you know what that would be worth today? Over $25,000. That's not some get-rich-quick scheme or lucky lottery ticket. That's the power of compound growth over time. And it's available to anyone with a few $100s and the willingness to learn the basics. Now, I can already hear some of you thinking, but what about all those people who lost money in the stock market? What about the crashes? And you're absolutely right to be concerned about that. The 2008 financial crisis, the dot-com bubble, the COVID-19 market volatility we all witnessed. These things are real, and they're part of the story. But here's what Kratter emphasizes throughout his book, and what I think is absolutely crucial for anyone just starting out to understand. The stock market isn't about timing perfect entries and exits. It's not about picking the next Tesla or Apple before they explode. It's about understanding the fundamental mechanics of how businesses create value, how markets work, and most importantly, how to protect yourself while participating in the long-term growth of the economy. You see, when you buy a stock, you're not just buying some abstract number that goes up and down on a screen. You're buying a tiny piece of a real business. When you own shares of McDonald's, you literally own a microscopic fraction of every Big Mac sold, every franchise fee collected, every real estate property they own. When people go to McDonald's more often, when they expand to new locations, when they create new menu items that people love, the value of your ownership stake grows. It's that simple and that powerful. But I get it. The whole thing can feel overwhelming when you're starting from zero. Where do you even begin? What's a broker? What's the difference between a stock and a bond? How do you know which companies to invest in? What if you make a mistake and lose all your money? These are exactly the questions that kept me up at night when I first started thinking about investing, and they're exactly the questions that Kratter addresses in a way that makes everything feel manageable and accessible. Let me share a personal story that really drives this home. About 5 years ago, I was having coffee with my college roommate, Mike. We were both making roughly the same salary at the time, both living similar lifestyles, both saving about the same amount of money each month. The only difference was that Mike had started investing his savings in index funds about 3 years earlier, while I was keeping mine in a high-yield savings account because I thought I was being smart and safe. When we compared our net worth that day, Mike's investments had grown by about $18,000 more than what I had in savings. $18,000! That's not chump change. That's a nice vacation, a down payment on a car, or several months of living expenses. The crazy part is, Mike wasn't doing anything fancy or complicated. He wasn't day trading or analyzing complex financial statements. He was simply putting a few $100s each month into broad market index funds and letting compound growth do its thing. That conversation was my wake-up call, and it's probably why I'm so passionate about sharing this knowledge with you today. Now, Kratter starts his book by addressing something that I think is absolutely brilliant. He talks about the psychological barriers that keep most people out of the stock market: fear of loss, fear of complexity, fear of making mistakes. But he reframes these fears in a way that really opened my eyes. He points out that not investing is actually the riskiest choice of all when you're young. Why? Because you have the most valuable asset in the world on your side, and that asset is time. Let's do some quick math that will blow your mind. If you're 25 years old and you invest $300 per month in the stock market, earning the historical average return of about 10% per year, by the time you're 65, you'll have over $2 million. $2 million. That's from just $300 a month. But here's the kicker. If you wait until you're 35 to start, that same $300 per month will only grow to about $800,000 by retirement. Still good money, but you've missed out on over $1 million just by waiting 10 years. That's the power of compound growth, and that's why Kratter emphasizes that the best time to start investing was yesterday, but the second best time is today. But let's get practical here, because I know some of you are thinking, okay, I'm convinced I need to start investing, but how do I actually do it without screwing up? This is where Kratter really shines in his approach. He doesn't overwhelm you with complex theories or advanced strategies. He starts with the absolute basics and builds from there. The first thing he talks about is understanding what a stock actually represents. I mentioned this earlier, but it's worth diving deeper because this fundamental concept changes everything about how you think about investing. When you buy a share of stock, you become a partial owner of that company. You have voting rights in major company decisions, you're entitled to a portion of the profits through dividends, and most importantly, you participate in the growth of the business. Think about a company like Starbucks. Every time someone buys a latte, a small fraction of that profit belongs to you as a shareholder. When Starbucks opens a new location and it becomes profitable, the value of your shares increases because the company is now generating more revenue. When they innovate with new products or find ways to operate more efficiently, you benefit from that success. This isn't gambling or speculation. This is participating in the growth of productive businesses. Now, Kratter also addresses one of the biggest misconceptions about stock market investing, and this one really resonates with my experience. A lot of people think that to be successful in the stock market, you need to be constantly buying and selling, trying to time the market, watching CNBC all day, and stress eating while you're watching your portfolio bounce up and down. But the reality is completely different. The most successful investors, the ones who build real wealth over time, are actually pretty boring in their approach. Warren Buffett, probably the most famous investor of all time, has a saying that I think perfectly captures this. He says his favorite holding period for a stock is forever. What he means is that when you find good companies trading at reasonable prices, the best strategy is often to buy them and hold them for years or even decades. Let the businesses do what businesses do best, which is grow and create value over time. This brings us to one of Kratter's key insights about risk. Most people think the stock market is risky because stock prices go up and down in the short term. And yes, that volatility is real. If you put money in the stock market today, there's a good chance it will be worth less tomorrow or next week or even next year. But here's what most people miss. Over longer periods, the stock market has been remarkably consistent in delivering positive returns. Since 1926, the S&P 500 has had positive returns in about 73% of all years. That means roughly 3 out of every 4 years, if you had invested in the broad stock market, you would have made money. But here's the really important part. Over every 20-year period since 1926, the stock market has never lost money. Never, not once. Even if you had the worst possible timing and invested right before the Great Depression or right before the 2008 financial crisis, if you held your investments for 20 years, you still would have come out ahead. This is why Kratter emphasizes that your age and investment timeline are crucial factors in determining your investment strategy. If you're in your 20s or 30s, you have decades before you'll need this money for retirement. Short-term volatility shouldn't concern you because you have time to ride out the ups and downs. In fact, market downturns can actually be opportunities to buy more shares at lower prices. I remember during the COVID-19 market crash in March 2020, when the market dropped by about 35% in just a few weeks. I'll admit, it was scary watching my portfolio lose value that quickly. But I remembered what I had learned about long-term investing, and instead of selling in panic, I actually increased my monthly investments because I knew I was buying shares at a discount. By the end of 2020, not only had the market recovered, but those extra shares I bought during the crash had contributed significantly to my overall gains. This brings us to one of the most important concepts in Kratter's book, and honestly, one of the most important concepts in all of investing: dollar cost averaging. This is a fancy term for a really simple strategy. Instead of trying to time the market by investing a large sum all at once, you invest a fixed amount of money at regular intervals, regardless of whether the market is up or down. Let me give you a practical example. Let's say you decide to invest $300 every month in an S&P 500 index fund. In January, the fund costs $50 per share, so you buy 6 shares. In February, the market goes down and the fund costs $40 per share, so your $300 buys you 7.5 shares. In March, the market recovers and the fund costs $60 per share, so you buy 5 shares. Over time, you end up buying more shares when prices are low and fewer shares when prices are high, which tends to smooth out your average cost per share. The beauty of dollar cost averaging is that it removes emotion and timing from the equation. You don't have to worry about whether now is a good time to invest or whether you should wait for the market to drop. You just invest the same amount every month like clockwork and let the strategy work for you over time. Now, Kratter also spends considerable time explaining the different types of investment accounts available to individual investors. And this is crucial information that I wish someone had explained to me when I first started. The type of account you choose can have huge implications for your taxes and your long-term wealth building. For most beginners, especially those just starting their careers, Kratter recommends focusing on tax-advantaged retirement accounts first. If your employer offers a 401k plan, especially if they provide matching contributions, this should be your absolute first priority. Let me explain why with a real-world example.
My friend Jessica works for a company that matches 50% of her 401k contributions up to 6% of her salary. She makes $60,000 per year, so if she contributes 6% of her salary, which is $3,600, her company adds another $1,800 to her account. That's an instant 50% return on her investment before any market gains. There's literally no other investment in the world that can guarantee you a 50% return immediately. But here's what's even better. That money grows tax-deferred, which means she doesn't pay taxes on the contributions or the gains until she withdraws the money in retirement. If she's in the 22% tax bracket now, contributing to her 401k saves her about $800 per year in taxes. So not only is she getting free money from her employer match, but she's also reducing her current tax bill. For those who don't have access to a 401k or who want to invest beyond their employer plan, Kratter explains the benefits of individual retirement accounts, or IRAs. There are two main types: traditional IRAs, which work similarly to 401ks with tax-deferred growth, and Roth IRAs, which are funded with after-tax dollars but grow tax-free forever. The Roth IRA is particularly powerful for young investors because you're likely in a lower tax bracket now than you will be in retirement. You pay taxes on the money you contribute today at your current rate, but then every dollar of growth over the next 40 years is completely tax-free. Imagine having $1 million in your Roth IRA when you retire and being able to withdraw all of it without paying a single cent in taxes. That's the power of tax-free compound growth. Now, once you have your tax-advantaged accounts set up and you're contributing regularly, the next question is what to actually invest in. This is where a lot of beginners get overwhelmed because there are literally thousands of stocks, bonds, mutual funds, and ETFs to choose from. But Kratter keeps it simple with advice that I think is perfect for beginners. For most new investors, he recommends starting with broad market index funds. These are investments that own tiny pieces of hundreds or thousands of different companies, giving you instant diversification without having to research individual stocks. The most popular and widely recommended is an S&P 500 index fund, which owns shares in the 500 largest publicly traded companies in the United States. When you buy shares in an S&P 500 index fund, you're essentially buying a tiny piece of Apple, Microsoft, Amazon, Google, Tesla, and hundreds of other companies all at once. You're betting on the long-term growth of the entire US economy, rather than trying to pick individual winners and losers. Historically, this has been a very good bet. The fees on these index funds are also incredibly low, often less than 0.1% per year. This might not sound like a big deal, but fees can eat away at your returns over time. If you're choosing between two investments that both earn 8% per year, but one charges 0.1% in fees, while the other charges 1.5% in fees, that 1.4% difference compounds over decades into hundreds of thousands of dollars in lost returns. Hey, if you're enjoying our free book summaries and want to support what we do, there are a few easy ways to help. You can subscribe to the channel, become a member, or grab the book using our affiliate link in the description. And if you'd like to go a step further, you can also leave a tip via PayPal or UPI. The link's below. Every bit of support helps us keep creating valuable content for you. Now, as you become more comfortable with investing and start to build wealth, Kratter introduces some slightly more advanced concepts that can enhance your returns and reduce your risk. One of these is international diversification. While the U.S. stock market has performed incredibly well over the long term, there are times when international markets outperform domestic markets. By adding some international exposure to your portfolio, you're not putting all your eggs in one basket. You're participating in the growth of companies and economies around the world. This might include European companies like Nestle or ASML, Japanese companies like Toyota or Nintendo, or emerging market companies in countries like China, India, or Brazil. Kratter also discusses the role of bonds in a diversified portfolio. Bonds are essentially loans that you make to companies or governments in exchange for regular interest payments. They're generally less risky than stocks, but also offer lower potential returns. For young investors, he typically recommends a portfolio that's heavily weighted towards stocks, maybe 80 to 90%, with a small allocation to bonds for stability. As you get older and closer to retirement, you might gradually shift toward a more conservative allocation with a higher percentage of bonds. The idea is that when you're young, you can afford to take more risk because you have time to recover from market downturns. As you get older, preserving your wealth becomes more important than growing it aggressively. Now, one of the sections in Kratter's book that I found particularly valuable deals with the emotional side of investing. He talks about the psychological biases that can sabotage even the best investment strategies. Fear and greed are the two primary emotions that drive poor investment decisions, and recognizing them in yourself is crucial for long-term success. Fear typically shows up during market downturns, when your portfolio is losing value and the financial media is predicting doom and gloom. Your natural instinct is to sell everything and hide your money under a mattress. But this is exactly the wrong time to sell. Market downturns are temporary, but selling during a downturn locks in your losses permanently. Greed, on the other hand, typically shows up during market bubbles. When everyone is talking about the latest hot stock or cryptocurrency, and it seems like everyone is getting rich except you, the temptation is to abandon your disciplined investment strategy and chase quick profits. But bubbles always burst, and the people who chase trends usually end up losing money.
I experienced this firsthand during the GameStop frenzy in early 2021. Everyone was talking about these meme stocks, and I watched people make huge gains in just a few days. The fear of missing out was real, and I seriously considered taking money out of my index funds to buy GameStop stock. Thankfully, I stuck to my long-term strategy, because most of the people who bought GameStop at the peak ended up losing 70 to 80% of their money when the bubble burst. This brings us to one of Kratter's most important pieces of advice. Have a written investment plan and stick to it. Your plan should include your investment goals, your risk tolerance, your asset allocation, and your strategy for rebalancing your portfolio. When emotions are running high, either from fear or greed, you can refer back to your plan to keep yourself on track. For most beginners, a simple plan might look something like this. I will invest $400 per month in a diversified portfolio consisting of 70% U.S. stock index funds, 20% international stock index funds, and 10% bond index funds. I will rebalance my portfolio once per year to maintain these allocations, and I will not make any changes to this strategy based on short-term market movements or media predictions. Having a plan like this written down and committed to paper makes it much easier to stay disciplined during volatile market periods. It removes the guesswork and emotional decision-making that can derail your long-term wealth building. Kratter also addresses some common mistakes that beginning investors make, and I think sharing these can save you from some expensive lessons. One of the biggest mistakes is trying to time the market. This is the belief that you can predict when stock prices will go up or down and adjust your investment strategy accordingly. The problem is that even professional fund managers with teams of analysts and sophisticated computer models fail at market timing consistently. Study after study has shown that the vast majority of actively managed funds underperform simple index funds over long periods, primarily because they're trying to time the market and pick individual stocks. For individual investors, market timing is even more dangerous because we don't have access to the same information and resources as professionals. We're also more likely to let emotions drive our decisions. The result is that most people who try to time the market end up buying high during periods of optimism and selling low during periods of fear, which is exactly the opposite of what you want to do. Another common mistake is putting too much money into individual stocks, especially stocks of companies you work for. I know it's tempting to invest heavily in your employer's stock, especially if you believe in the company and you get employee discounts on stock purchases. But this creates a dangerous concentration of risk. If something bad happens to your company, not only could you lose your job, but your investment portfolio could also take a major hit. It's much safer to limit individual stock holdings to a small percentage of your overall portfolio and focus the majority of your investments on diversified index funds. Kratter also warns against the danger of following hot tips from friends, family, or social media. Everyone has a story about the stock that doubled or tripled in value, but they rarely talk about the stocks that lost 50 or 70% of their value. Individual stock picking is extremely difficult, even for professionals, and the odds are stacked against you. Instead of trying to find the next big winner, Focus on the proven strategy of buying and holding diversified index funds. It might not be as exciting as hitting a home run on an individual stock, but it's much more likely to build real wealth over time.
As we near the end of our discussion, I want to share one more personal story that really illustrates the power of what Kratter teaches in this book. My cousin David started investing when he was 22 years old, fresh out of college and making $35,000 per year at his first job. He could only afford to invest about $150 per month, but he was consistent about it. Fast forward 15 years, and David is now making $80,000 per year and has increased his monthly investments to about $800. But here's the amazing part. Those early investments he made when he was 22, when he could barely afford $150 per month, are now worth more than the investments he's making today, even though he's investing 5 times as much each month. That's compound growth in action, and that's why starting early is so incredibly powerful. The key takeaways from Kratter's book and from everything we've discussed today can be summed up in a few simple principles that anyone can follow. First, start investing as early as possible, even if you can only afford small amounts. Time is your most valuable asset when it comes to building wealth, and compound growth becomes exponentially more powerful the longer you let it work. Second, keep it simple with broad market index funds. You don't need to be a stock-picking genius or spend hours researching individual companies. The entire U.S. economy has grown consistently over time, and index funds let you participate in that growth with minimal effort and low fees. Third, invest regularly regardless of market conditions. Dollar-cost averaging removes the need to time the market and helps smooth out volatility over time. Set up automatic investments so you don't have to think about it or let emotions interfere with your strategy. Fourth, maximize tax-advantaged accounts before investing in regular brokerage accounts. The tax savings and employer matching contributions available through 401ks and IRAs can add hundreds of thousands of dollars to your long-term wealth. Fifth, stay the course during market volatility. Downturns are temporary, but selling during downturns makes your losses permanent. Market corrections are actually opportunities to buy more shares at lower prices if you have a long-term investment horizon. And finally, educate yourself continuously. The more you understand about investing and personal finance, the better decisions you'll make and the more confident you'll feel during uncertain times. Books like Kratter's are just the beginning. There are podcasts, blogs, and courses that can deepen your knowledge and help you refine your investment strategy over time. I want to leave you with this thought. Every wealthy person you admire, every financially independent person you know, started exactly where you are right now. They weren't born with special knowledge or advantages. They simply understood the power of compound growth and had the discipline to invest consistently over time. The stock market isn't just for Wall Street professionals or people with huge amounts of money to invest. It's for anyone who wants to build wealth and secure their financial future. The beautiful thing about living in this era is that investing has never been more accessible or affordable. You can open an investment account with most brokers for free, start investing with as little as $1, and access diversified index funds with incredibly low fees. The barriers that might have prevented previous generations from participating in the stock market have largely disappeared. Your future self will thank you for taking action today. Whether you start with $50 per month or $500 per month, the important thing is to start. Open that investment account, set up automatic contributions, choose a simple index fund portfolio, and let compound growth begin working its magic. 10, 20, or 30 years from now, when you're looking at a portfolio worth hundreds of thousands or millions of dollars, you'll remember this moment as the turning point in your financial life. Remember, building wealth through the stock market isn't about getting rich quick. It's about getting rich slowly and surely through the power of compound growth, diversification, and time. Matthew Kratter's book gives you everything you need to know to start that journey, and I hope our discussion today has inspired you to take that first step. Your financially independent future is waiting for you, and it all begins with the decision to start investing today.